Welcome to our weekly Forex and Futures forecast. My name is Jay Norris. I teach the art of trading at Trading University. First market we'll take a look at will be the Australian US dollar. Aus US dollar reversed course short term, went back higher, made a higher high, and just kissed that resistance level there. That's a key level, by the way, if you're looking at it. If you look at the overall pattern here, the red box outlines your primary pattern. The primary pattern is still lower. You've had a full two-third retracement of the primary pattern. Definitely interesting place on the chart here. We may want to keep an eye on that level to see if you get if resistance holds essentially, and then you get a momentum shift south there. So overall, both intermediate term and short term, we're still buying. We're back to buying dips. This guy's short term. We've been buying dips intermediate term, a little bit longer term. But you know, the big picture, the primary, you don't often get a shot at primary pattern resistance. So it's going to be interesting to see how that unfolds. So from a position trader standpoint, long term investor standpoint, this is a very interesting level to see if we get a shift in momentum south, and then we'll go short that guy. Next market, dollar Swiss. You know, I've been saying it all along. If I like this guy at 98, I love it at 97. I'm ecstatic. You get it down below 96, and there you have it. And here's another guy where here's your primary pattern. This would be that would mark the primary trend, and now you're getting a shot at a two-third retracement of that. Doesn't happen too often. Very powerful stuff. It says in Dow theory, primary pattern can retrace up to two-thirds of itself and still maintain that overall pattern, and you're looking at it. So we love this guy. I've got a little bit of dry powder left as far as cash positions in here, so I'm loving the idea of adding to existing longs here. You know, just a word on the U.S. economy. It's flying. I mean, this weekend was a big retail weekend. People out there spending money, and we think that'll show up in the numbers later in the year. But it's definitely going to be a blowout spring for business here in the U.S. and likely around the globe too. So we still like overall, we love U.S. dollars long term. Nothing's changed here. It's just, you know, the hardest part about trading, as Charles Dow said, trying to predict retracements and how far they're going to run, but generally they don't run more than two-thirds. So very interesting area on the chart here. We still see this. Well, we called it back here when it dipped in there. We called it the trade of the decade. Now we see it as the investment of the decade. Still love that level. Dollar index. Well, the more I study markets longer term, anyway, the more I have respect for patient people. Investing takes a ton of patience. Very interesting, fascinating stuff. Trading doesn't take as much patience. Trading, you can trade either way, both long and short. Anyway, here's the dollar index, and the reason you see the box on the chart, I don't often call a market neutral, but I have to say the primary pattern is just flat in the water. You could see where that market came from. A huge rally in 2014, the beginning of 2015, but now, I mean, that's the only way to call it. It's just flat, right? So similar, I guess, to the dollar Swiss, where you gotta like that level in the dollar Swiss. Similar, you gotta like this long-term level in the dollar too. So I think you get below 94 even, you gotta start accumulating this guy. It's an index though; it's a futures index, so kind of hard to accumulate that. Nothing wrong with accumulating a currency, because you can put, you know, a few $1,000s in there, a few $10,000 in there. You start to nibble. You always weigh that position to make sure it's not gonna cause you any stress, make you lose sleep, and in the long run, it's gonna pay off. Here, a little bit different because it's a future, but there you go. You see that short-term pattern down, intermediate-term pattern down, long-term. You're just in a box. You just have to be patient. Maybe start to utilize leverage if you get a test of. Hopefully, we'll see. Well, I would imagine you'll see a band of support between 94, even to 92. Even if you turn around in there and get a shift in momentum higher, maybe that'd be the way to go at it. But for now, you know, any kind of leverage, you got to have stops on it. Next market, the euro. Euro is similar. I've got a box on there, and you know, it's your primary pattern. It's neutral. I rarely see a market's neutral, because to me it's not. It's either bullish or bearish. Well, you look on some time frame and you'll get some play in it. Euro on the shorter term, you can see you've got the short-term pattern is bullish here, up as they continue to extend that rally. Intermediate term pattern, you got a nice rally there. You're getting upwards towards the top of that box. Overall, I do see a breakout of this area, so you probably have a little bit of room on top. You may even, push that guy as far as 18 even. So you do have a breakout of sorts here. That doesn't necessarily mean that the market continues higher. It just means, hey, the next dip, you get a big dip in the euro, it may be attractive from the buy side. So we'll have to keep an eye on that. But long term, investor standpoint, it's still sideways. Definitely wouldn't initiate longs from an investor standpoint. A trader, that's different. I love being a trader, and that's where we started. We generally only taught day trading initially. Now we're delving into the swing trading and the position trading. But I tell you why. Here's why I love teaching day trading, because you can swing either way. Here's our performance year to date, and you can see here's where we came in at the end of the year. Basically, that's our benchmark, and you can see every signal we took in here. And March got a little choppy there, but at the end of the month, you still had a little bit more than you started with. Also, we missed a trade. There's another trade in there that I still have to add on there. So March got it above 67 there, so it went in the high 65s to the low 67. So making progress, slow month overall, but really good year though. But I make a point here because you could swing either way. Here you can see over here where the trades were taken. Well, we just started buying. We were selling for a while. We're buying for a while. I mean, you're going to trade both sides. And a trader, you have to trade at both sides. Investor, completely different animal, completely. But here, back to the euro. Investor standpoint, you're in a sideways market. Short term and intermediate term, from a trader's perspective, you're buying dips. No need to cover the U.S. stock market. It's on firm footing. It's doing well. The next market we'll take a look at will be gold. Kind of surprising with that short-term breakout in the euro, that gold, which by the way, pretty much a leading indicator market, gold still in sell the rally mode for us, both from a short-term perspective. Well, from a short-term perspective, you're selling rallies. Long-term investor, you'd be short gold. Intermediate swing trader, you're interested in buying dips in gold. I'll have to look out and see where that's a 30-day pattern down in gold. I want to see where that 60-day pattern comes in, because I'd be looking for support there. Oh, that white line, that's your weekly. That's the low of the highest closing candle on the weekly, and you see it held support, couldn't close below there. So gold, again, from an intermediate swing trader's perspective, you're probably eyeballing buying dips. Short-term trader, you're selling rallies. Investor, you wouldn't want to be long that guy. You'd be considering a long-term short position in gold, and you see that's even longer than a primary. It's kind of your super primary pattern down in gold. Last market we'll take a look at will be U.S. interest rates in the form of the 10-year note. Pan out to weekly to get the big picture on rates. Basically, as the 10-year note goes down, U.S. interest rates go up. You can see that despite a good unemployment number, that the rates did go up. Therefore, interest rates going down. That's dollar bearish. Intermediate short term, so strong notes tends to be dollar bearish. Weaker notes, higher interest rates, that'd be dollar bullish. So right now you held long-term resistance there in the 10-year note. However, investors they love treasuries. They're running back into treasuries. That's supporting the treasury market, and that's putting a hold on the big dollar rally. Overall, though, however, we still see a blowout cycle on the upside in U.S. business, and we think overall that'll be dollar bullish. I go closer to the summer, but for now we're in a defensive stance, and it's good to be a trader because you can trade both sides. Here's our benchmark year to date. We'll leave you with that picture. Thank you so much. My name is Jay Norris. I teach the art of trading at Trading University, and we'll see you next week.